Good evening and welcome to iBanker U News tonight, Wednesday, January 28th, 2026. Cold out there, beautiful if you're paying attention, and confusing if you're not, much like today's markets. If you're new here, you're in the right place. Tonight we're going to walk through something every investor wrestles with: risk-adjusted returns, portfolio allocation, and the trade-offs between volatility and survivability. In our first two reports, we talked about tail risk hedges, gold and silver, and in our third report, the asymmetric upside that is Bitcoin. Tiny allocations, but critically important for convexity and shock absorption. Tonight, we're talking about the other 85 to 90%, core holdings, beta exposure, and long duration equities. The stuff that actually drives your portfolio over decades. And we're going to do it through a simple but revealing allegory. 3 investors walk into a bar, 3 risk frameworks, 3 approaches to alpha generation. Only one of them walks out unscathed. Who survives and why? First, James Bond. Cambridge educated, could have gone into investment banking, private equity, hedge fund arbitrage, but no. Bond trades in markets like he trades in lives. High conviction, asymmetric payoff, and high beta. In portfolio terms, he's leveraged optionality. His allocation skew towards convex instruments, deep out-of-the-money call options. Bitcoin is a digital convexity asset, narrative-driven, high volatility equities. Bond doesn't care about beta-adjusted returns. He wants positive skew. One tail event can cover dozens of flat trades. Total drawdown risk, always present. That's his alpha, and it's explosive if it lands. Next, Jesse Livermore, the boy plunger, born in 1877, the archetype of technical trading, not indicators, not RSI or MACD, but pure price action, market microstructure, and liquidity dynamics. He's a master of trend-following strategies, volatility arbitrage, and momentum capture. Think of him as a proto-algo trader exploiting market inefficiencies, liquidity vacuums, and panic-driven microstructure gaps. QQ when it breaks relative highs? Check. Silver in confirmed uptrends? Yes, please. High volume, high beta sector leaders? Absolutely. Livermore doesn't care about fundamentals. He monitors tick level flows, support resistance levels, and macro correlation structures. Genius when trends persist, catastrophic when correlations break. His Sharpe ratio is episodic, but when it hits hard. Finally, Ben Graham, professor, mentor to Warren Buffett, and the father of value investing. Graham doesn't speculate. He analyzes intrinsic value, earning stability, debt to equity ratios, dividend discount models, and balance sheet integrity. He applies fundamental analysis to calculate a margin of safety, looking for securities trading well below discount cash flow or net asset value. Broad, low beta equities at reasonable valuations? Check. Cash flow positive defensive equities with a strong ROIC? You know it. Gold and cash as systemic hedges? Absolutely. Graham wants low volatility, high resilience positions. He structures portfolios to survive drawdowns and regime changes, using cash and high-quality fixed income to maintain liquidity and optionality. In short, Graham doesn't chase alpha, he preserves it. Let's talk about what each would actually buy in today's markets. Bond, convexity plays. Bitcoin is a non-correlated digital asset, QQQ options or leveraged ETFs, and high beta thematic equities in sectors with narrative-driven gamma potential. Bond is long tail risk, long optionality, and short boredom. He thrives on positive skew. Livermore, he's trend-following plays. QQQ and SPX momentum trades. Silver in confirmed upward channels, sector rotation leaders with liquidity. He's monitoring market breadth, sector correlation matrices, and intraday flow patterns. His P&L swings are asymmetric, high upside, high downside. Graham, Core allocation, SPX or broad-based ETFs trading below intrinsic value, defensive dividend growers, cash and gold as systemic hedges, low volatility, high certainty, high margin of safety, uses fundamental ratios, price to earnings, price to book, debt to equity, current ratio, dividend coverage. Beta is deliberately low. Think about this. One man chases gamma, one man chases momentum, one chases survivability. Which approach survives a 50% drawdown, a regime shift, a liquidity squeeze? Who walks out? All three survive, but not equally. Bond survives most of the time because one successful tail event offsets dozens of zero return trades. Livermore survives until a regime shift hits, correlations break, trends reverse, leverage magnifies losses, and Graham survives inevitably. He may look slow, boring, late, but he's still standing after the drawdown, after the volatility shock, after the bar closes. Markets don't punish stupidity, they punish misaligned risk management. Bond's edge is convexity. Livermore's edge is trend capture. Graham's edge is fundamental resilience and optionality. And in this story, Graham knows when to leave. He exits with capital intact. Bond and Livermore? Too often, they overstay, gamma decays, and leverage explodes. Here's Graham's blueprint. His bar napkin allocation for survival first investing. 40% broad equities, SPX-like, diversified, profitable, dividend-paying, low beta, own productive enterprise, not story-driven volatility. 20% defensive stocks, asset-rich, low leverage, high free cash flow, conservative valuation multiples, think SCHD or VYM equivalents. 20% cash, optionality, liquidity, dry powder, margin of safety, and for redeployment. 15% gold and silver. It's a hedge against systemic shocks, fiat currency debasement, and tail risk events. And 5% or so, special situations, liquidations, net effects, forced sellers, pure arithmetic over narrative. No single person can kill this portfolio. Volatility is survivable, correlations may spike, but liquidity is preserved. Timing and heroics are optional. Bond leaves rich or broke. Livermore leaves early or not at all. Graham, always intact. The lesson? If you don't know the worst player at the card table, it's probably you. Calculate your odds, allocate where you can quantify margin of safety, tail risk hedges, optionality, momentum, fine. But survival first portfolios win in the long run. That's Graham's path. Follow it, and odds are you'll walk out of the market bar with your capital intact, while the gamma chasers and trend chasers, well, they may be on the floor counting losses. Thanks for watching. Comment, like, subscribe, and in the meantime, take care of yourself and each other. Teleprompter's coming, I promise.